Welcome to Industry Trends Impacting Credit Scores, which is the third of 3 videos provided by Advantage Credit. Now, the following slides should share information with you in regards to things that we see that I believe will help improve your overall credit file and your credit scores. Let me first share with you some recent changes that I believe will help you as well. Now, if you are currently renting in an apartment complex, the good news is Experian is now reporting rental history since December of 2010, and they're furnishing this information through Rent Bureau, and that positive rental history may show up on your credit report. And in some cases, when you have a very thin credit file, having that additional payment history on a rental property can help improve your overall standing when you're applying for a mortgage loan. Now, currently that rental history does not impact the FICO score, but again, it will show up on the credit report. Now, in February 2011, the IRS announced that once a tax lien is paid, it could be removed from the credit report. So once you've paid off a federal tax lien, you can submit paperwork to the IRS, and usually within about 6 to 8 weeks, they will actually remove that tax lien from your credit report. Now, you may recall in the very first video, once you pay off a federal tax lien, it stays on your report for an additional 10 years. So this is a huge improvement on removing that tax lien very quickly. Here's another good item that could be coming around the corner. We wanted to share with you because we do believe this will change in the near future. And that is with medical collections. And quite often we find on credit reports, medical collections, most people are not aware that they have a medical collection, especially a small amount that maybe somehow the bill did not get to them, an address was changed, etc. And now you want to pay that medical collection immediately so you can apply for that mortgage. Well, today, if you pay off a medical collection, it actually brings the date forward on that collection on your credit report, and in most cases it could lower your FICO score because it's bringing that collection date forward. This amendment to the Fair Credit Reporting Act would apply that once you pay off a medical debt, a medical collection, that it would be removed automatically within 45 days. So stay tuned. Hopefully we'll see a change with that in the very near future. Now, Fair Isaac Company also rolled out a new FICO score algorithm back in 2008 called FICO 08. Now, the current status is it is available to all credit reporting agencies, and in most cases, most banks, 5 of the 7 largest banks, and 4 of the largest credit card issuers have begun using this FICO 08 scoring model. However, if when applying for a mortgage, currently Fannie Mae and Freddie Mac have not approved this, but we do want to share some of the upcoming changes we may see in a future FICO score update. And you're going to see that most of these are very positive. One is they will continue to recognize authorized users, legitimate authorized user accounts, meaning immediate family members, mother, father, son, daughter, etc. And then they're going to expand the problem segments from 2 to 4, meaning that as you recall maybe in that first video, that if you have just one late payment show up on your credit report, your score could potentially drop by as much as 100 points. So by expanding from 2 to 4 segments, if you have just maybe one mistake on your credit report, that one late payment, that one collection, instead of maybe a 100-point impact, possibly you'll see your score only impacted by 40 or 50 points to make it a more fair playing field. Now, collections will be ignored at $100 or less. Now, they'll still be on your credit report, but they will not be factored into your FICO score, which is great news as well. And then, of course, the continued emphasis on don't close those accounts with payment history, continue to use them. And then there's going to be more weight applied on credit card balances when they are at 10% of the high credit. You may have heard me mention in that first video that the goal would be is to always have your credit card balances, your line of credit, at 30% of the high credit. So if your credit card has a $1,000 credit limit, your goal should be is to get that balance down to $300, which is still good, but you'll see even a greater impact by getting it down to 10%, or in that example, $100. Now, it wasn't too long ago that a FICO score of 680 would allow you to get the best interest rate on any type of loan, whether it be FHA, Fannie Mae, etc. Now, if you have a property that you're interested in buying and it is not FHA approved, you must go conventional. Now, today, to get a conventional loan at the best interest rate, your score must be 740 or greater. Now, again, FHA FICO score requirements are lower than that, but I just want to show you how much of an impact FICO scores have on your buying power. Now, for example, if your FICO score is in the 670 range and you must go conventional on a $250,000 loan example, you would have to pay potentially up to $7,500 in points up front to get the best interest rate. If you choose to accept the rate that normally would be given with a FICO score of 670, you may pay up to $9,000 or more in interest alone, additional interest, just in the next 3 years. So definitely that FICO score is going to impact your buying power and also cost you additional money. Now let me give you an example of how that works. Let's say you're looking for a home in the 350 range. You're going to put 10% down and your loan amount is 315. If your FICO score, and just as an example, don't hold me to this, if your FICO score is 719, your principal interest payment may be around $1,978. If your FICO score is just 40 points lower, your payment could be an additional $60 a month. And if your FICO score is an additional 30 points or $649, you could be paying an additional $230 per month for that exact same loan. Now, when you are being financed or pursued to be approved for a mortgage, they also look at front-end, back-end ratios. And a front-end ratio takes into consideration this payment of $1,978, your taxes, your insurance, HOA dues, etc. So let's say you can only be approved for a loan with a payment of $1,978. Well, based on a $1,978 payment of principal and interest, if your FICO score is 719, you're in the door, you're going to be able to get approved for a home in the 350 range. But if your FICO score is just 40 points lower, then you only can afford a house in the 340 range. And if you're at 649, you can see a drastic change in that purchase price. Now keep in mind, the only thing that changed was your FICO score. Now there is a general rule of thumb you could use, and again, it depends on your overall credit. So it depends on your credit mix, what kind of accounts you have, your payment history, etc. But the general rule of thumb is for every credit card that you have a high balance, which is 80% or greater than the credit limit, or equal to the credit limit, that if you pay that credit card down to 10% of the credit limit, on average you could see close to a 20-point increase per credit card. So in this example, to get from 649 to 719 might only require you paying down 3 or 4 credit card balances. Now, Loan Quality Initiative actually rolled out many years ago, and there were many factors considering verification of your Social Security, your identity, etc. And there's really just one thing we wanted to point out, and you want to be very careful about. Now, this has always been the case, but now it's even more important. And that is when you apply for a mortgage, and once you're approved, prior to closing, and usually that's within a couple days, if possibly even a day before closing, they're going to go back and verify any undisclosed liabilities. So it's extremely important that when you apply for a mortgage, do not borrow any additional money or apply for any additional loans. Don't go out and buy that new car or buy the furniture or items for your new house. Wait until after you've closed on the loan and you've moved into your home, because again, they're going to verify to make sure you haven't gone out and applied for additional lending. Now again, as we finished each video, there's really 4 things to focus on or to live by and include to help improve or keep your credit scores at a very high level. One is, don't open new accounts unless you don't have that perfect credit mix, which is usually 2 installment loans and 3 credit cards. And then don't close those accounts that you've had long payment history on, since payment history makes up close to 50% of your FICO score. Now keep that revolving debt to a minimum, so credit cards, lines of credit, keep that balance to 30% of the high credit, or even target that 10%, that new target as well. And then, of course, pay your bills on time. I encourage you to view our other videos on understanding credit scores and improving credit scores and avoiding identity theft. I hope you found this information helpful, and thank you for viewing Industry Trends Impacting Credit Scores.